After a strong market rally, valuations are higher than earlier this year, but are there underappreciated sectors with growth potentials? Let's explore sectors and themes offering attractive opportunities, especially with structural growth potential. Let's look at the technology sector first, where we expect more earnings upgrades. China's path to self-sufficiency in technology is non-reversible. The development of new technologies such as AI, humanoid robots, and autonomous driving is still at an early stage. While early-stage investment in AI infrastructure may gradually decelerate, the widening of AI applications should accelerate demand growth for related downstream segments in the value chain. This should support earnings upgrades and drive further rally in the sector performance. Costs of drug development and clinical trials in China and Asia are much lower than in the Western countries, while quality is comparable. Large out-licensing orders by the global pharmas to the China biotech companies should accelerate drug development and clinical trials, benefiting companies in the value chain, including the biotech companies and the CXO, the contract research companies. Recent sector corrections offer attractive entry points for the high-quality names. And then, the new consumption sector. The post-90s generation and people born after 2000 are the new driving force for the consumer sector, with distinct patterns. For example, they are less interested in property purchase, meaning less mortgage burden, freeing up their real disposable income. Younger consumers prioritize goods and services that brought joy and provides emotional values, boosting sectors like IP toys, pets, jewelry, cosmetics, and cultural and tourism. Recent corrections have made valuation in these sectors more reasonable, presenting buying opportunities. Looking ahead to the next 6 months in the China market, what are the key risks and opportunities in the horizon? Let's break it down, starting with the risks and challenges. Uncertainty persists in the China-US relationship, particularly if Trump seeks for more bargaining chips for his midterm election. This could lead to a potential escalation in the trade war with higher tariffs and more trade restrictions. Such developments could negatively impact on China's export growth and then drag on China's growth outlook. While in the domestic economy, low consumer and investor confidence, if not rebuilt, could dampen traditional consumption and investment sentiment. This is already reflected in the recent weak restaurant and retail consumption data, as well as the low capital expenditure incentives in manufacturing sector. This could potentially lead to weaker than expected growth and at the same time drag the corporate earnings. Looking into overseas, the US as a major global economy and key trading partner for China faces significant economic challenges. If unresolved, this could tip into recession and hence weaken the order for Chinese products. Similarly, if economic condition in Europe weakens, it could also negatively impact export demand for China. Next, we will look into the opportunities. Firstly, about policy support. We expect enhanced measures in the equity and property markets to rebuild confidence. In the technology sectors, we also expect more policy support to accelerate self-sufficiency, and in domestic consumption to stimulate broader economic growth. Further asset reallocation could be another opportunity ahead. As confidence rebuilds, we anticipate a shift from household savings towards equity investments and consumption, providing fresh momentum to the market. So, in conclusion, despite the strong rally year-to-date, we are still positive in the long-term outlook of the China market. While there are certain risk factors that could increase market volatility in the near term, we also see opportunities that from the policy support and assets reallocation angles. We prefer sectors or stocks that comes with fundamental supports, including potentials for structural growth and earnings upside, such as technology, new consumption, healthcare sectors, etc., instead of stocks that rallied purely on valuation expansion. Therefore, while the rapid pace of upturn might prompt some near-term profit-taking, with the combination of factors in place, our view is still buy to the dips, not sell to the rally.